Good evening, participants. I, Chaitanya Bansal, on behalf of Team Corporate Law Advisor and CII, welcome you all to today's session of Live Channel on Corporate Law. Today's session is focused on amendments to Schedule 3 of Companies Act, which has been made applicable from 1st April 2021 and its related issues. The session shall be undertaken by CSIP Amit Gupta sir, Anshul Jain, CS Anshul Jain sir, CS Thirupal Georgi sir, CA Pramod Jain sir, and CA Raghuveer sir. Amit sir is a practicing company secretary and an insolvency practitioner having experience of more than 2 decades. He is the chairman and member of various boards of ICSI and has contributed significantly in development of new curriculum of company secretaryship course, which came into effect from 2017. Anshul sir is a fellow member of ICSI and presently working with Reliance Industry, where he takes care of retail and land-related entities of the group. He is a member of Auditing Standards Board since its inception and is also a member of research group of ICSI and also a part of its premier team. He is a regular speaker at various programs and organized by CS Institute, CA Institute, and other institutions. Thirupal Georgi sir is a practicing company secretary and an insolvency professional. He regularly appears before various judicial and quasi-judicial authorities. He is one of the co-resource persons for the Blue Book released by ICSI and has been invited as a speaker by various reputed institutions. Pramod sir is a fellow member of CA Institute. He has been elected as Central Council member of ICAI for the period 2019 to 21. Apart from being member in more than 25 committees, groups, directorates of ICAI, he is chairman of Valuation Standards Board and CSR Committee of ICAI for the year 2020 to 21. He is the founder of expertspanel.in, which is a one-stop solution for all professional queries. He is also a prolific writer and has authorized several books. Raghuveer sir is a fellow member of CA Institute with an experience of more than a decade. He is presently a partner at Gargesh and Company, a firm of chartered accountants. He is also the vice chairman of Mysuru bench of SIRC of ICAI. He is a prolific writer and speaker and has written several articles and has also been invited in various training programs. Before we begin this session, I would like to request all participants to please be on mute. During the session, if any participant has any query, feel free to post it in the chat and they will be duly answered. With these words, I now hand over the dice to Raghuveer sir. Thank you.
Thank you, sir. I welcome all the participants for today's session. Today we will be deliberating on the changes made in the Schedule 3 to the Companies Act 2030. Can I share my screen, sir?
Yes, sir, you can.
Is it visible, sir?
Yes.
Yes, sir.
The Ministry of Corporate Affairs, via its notification dated 24th March 2021, has amended the Schedule 3 of Companies Act. Schedule 3 has 3 divisions: Division 1, Division 2, Division 3. Division is one applicable for the companies which follow accounting standards. Division 2 is applicable for the companies which follow Indian accounting standards, and Division 3 is applicable for the NBFC companies. So why this notification? The MCA has amended all the made changes in all the three divisions. So the basically this the changes which have been made in these three in the by this notification, it has the impact of enhanced disclosure for companies which follow Indian GAAP, Ind AS, and NBFC. And this the changes which have been made in this note to write this notification is basically to align the reporting requirements which is required as per CARO 2020. As you all know, CARO 2020 is also been brought in, but the implementation of that is postponed to 1/4/22. So to bring the Schedule 3 also in line with CARO, these amendments have been made. Basically, this is applicable from 1/4/21. But what happens is in Schedule 3, when we prepare the financials, we will have to give the previous year comparatives also. So even though it is applicable from 1/4/21, that is financial year 21/22, we will have to work from now only, because we will have to give the comparatives for 2021 for whatever changes have been made. So the necessary changes in IT systems also have to be made. So basically, I will discuss what are the changes which have been made by this notification, and which has amended the Schedule 3. So Schedule 3 has three parts. One is the general guidelines. Another is balance sheet and P&L, and the other notes which has to be part of this balance sheet and P&L. So there are changes in all these three parts. First, I will deal with balance sheet. So the first change what they have made is they have introduced a concept of terminology of total income. So wherever it was appearing as turnover, now it is made as total income. So earlier the rounding of numbers was applicable for only Ind AS companies, was mandatory for Ind AS companies. Now this has been made mandatory for the companies which prepare their financials on normal accounting standards also. So for this rounding off, the earlier criteria was turnover. Now the criteria is total income. So another change which they have made is a change in the presentation. Earlier, it was only called the property, plant, and equipment. Now it will be called property, plant, equipment, and intangible assets. So this is a minor change in the presentation. So next, there is a big change. Earlier, what we used to do is we only used to give shareholders who were holding details of shareholders who were holding more than 5% share capital. Now, what they have done is they have also introduced that you have to disclose the promoter's shareholding in the balance sheet itself. So this is a big change. Promoters holding, it was also mandatory for listed companies under LODR regulations. Now this has been brought in the Schedule 3 also. So promoters here means promoters as defined in the Companies Act 2013. So details has to be given for each class of shares, and the percentage change has to be computed with respect to numbers at the beginning of the year. And if it is issued in between the year for the first time, from that date, the percentage change has to be calculated. So this is the details have to be given in this format: serial number, promoter name, number of shares, and percentage of total shares. So the next important change which has been made to Schedule 3 is in the disclosure of short-term borrowings. So earlier, the current maturities of long-term borrowings was disclosed under the head other current liabilities. Now the current maturities of long-term borrowings has to be disclosed under the head short-term borrowings only, and it need not be disclosed under other current liabilities. So one next change which they have brought in liability side of the balance sheet is trade payables due for payment. So trade payables, earlier there was no requirement of giving aging of the trade payables. Now, earlier only we used to give payables due to MSME vendors and payable due to other vendors. Now, there is a big change. We have to give dues to MSME vendors and dues to others. And we have also to disclose whether any disputes are there. Disputed dues to MSME vendors and disputed dues to other vendors. And also aging. That is trade payables pending less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. And this has to be, the details has to be provided based on the due date of payment. Next change what they have brought in schedule 3 is, earlier we were giving reconciliation of gross assets, net carrying assets. Now they have brought in a change that we have to show separately if there is any acquisition additions as a result of revaluation of property, plant and equipment, or as a result of business combinations. This has to be disclosed separately. Earlier this was not required. Now this has to be separately disclosed. This same change has also been brought in case of intangible assets also. Property, plant and equipment and intangibles. In both the places, this reconciliation has to be given. So next change is, this is a small change. Security deposits was disclosed under long-term loans and advances. Now this has to be disclosed under other non-current assets. Next big change which has been brought in is regarding trade receivables. Earlier, trade receivables, we used to disclose trade receivables outstanding for less than 6 months and outstanding for more than 6 months. Now the aging of these trade receivables has been expanded. Now it has to be given for less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. Not only the aging has to be given, as given in the trade payables, in this schedule also we have to give how much is disputed trade receivables and how much is undisputed trade receivables. And also we have to give how much trade receivables this undisputed is considered as good and considered as doubtful, and how much trade receivables this disclosures has to be given now. So next big change which they have brought in is where the company has no, if the companies have borrowed monies from banks, the banks normally specify, especially in the case of term loans, they especially give the end use for which it has to be used. So if the company has not used the money for the purpose it was borrowed, then it has to be disclosed where the company has used that money other than the purpose for which it was intended to be used. And if earlier, the next change is, in the opinion of board, any assets uh, other than property, plant and equipment and non-current investments did not realize the value which it has been stated in the ordinary course of business in the balance sheet, the board had to make a statement that the board is of the opinion that the values which it has been stated, it will not realize at that value. Now, this has to be provided for intangible assets also earlier. Now, intangible assets has been excluded from that opinion declaration. So this is the basic, all the changes which have been made in the balance sheet and its notes. So next we go to other regulatory information, the changes which have been made. Here, instead of calling it as change, this is additional information is called for from the companies. First is the most important change is title deed of immovable properties. The company should provide details of all those title deed. This is basically for immovable properties. Company should provide title deeds of all immovable properties which are not held in the name of company in the format specified, except leases. If the company has entered into a lease agreement, it will not be obviously in the company's name. That need not be disclosed. If there are any other immovable properties which are disclosed in the balance sheet and the title deed of those immovable properties are not in the name of company, it has to be disclosed as by way of note in the specified format. and where the company has revalued its property, plant and equipment, or intangibles or investment properties, companies also have to disclose whether the revaluation is based on the valuation by a registered valuer as defined under Rule 2 of Companies Registration Valuers and Valuation Rules 2017. Next important change which has been brought in is disclosure of loans and advances given to KMPs, where any loans and advances are given to promoters, KMPs, or the related parties, and where and those if those loans are repayable on demand, or if the loans have been given without specifying any terms of repayment or schedule, then it has to be disclosed. These kind of loans have to be disclosed as an additional information in the specified format given. The next big change which has been introduced is with respect to disclosures or capital work in progress. Earlier, there was no requirement of any kind of disclosure relating to capital work in progress. Now, the aging schedule of the capital work in progress has to be given for projects in progress and also for projects which have been temporarily suspended. So it has to be given for less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. Uh, Not only that, if there is any delay in the from the budgeted time period or budget, if there are any cost overruns for these capital work in progress, the details of those cost overruns and also the estimated time required to complete these projects also has to be given. It has to be given project wise. Each project, how much time it will take, how much in time period it will be completed, like less than 1 year, 1 to 2 years, 2 to 3 years. So this is a very, very critical change which have been brought in. So this change may result in more audit procedures because impairment testing may go up for this capital work in progress, and many other consequences like the period up to which the amounts can be capitalized in this capital work in progress. So these kind of issues may come up, and this is an entirely new disclosure which was earlier not there, has been introduced here. And not only this has to be given for capital work in progress for tangible assets, this also the same information also has to be given for intangible assets also. Next important disclosure which have been brought in uh, is uh, relating to Benami property held. So if there are any proceedings initiated by any department under the Benami Transactions Prohibition Act 1988 and the rules made under, then the company shall disclose the following: details of such property, including year of acquisition, amount thereof, and who are the beneficiaries of those Benami properties, and if the property is in the books, where it has been accounted for in the books, and where there are proceeding against the company under this law uh, as an better of transaction or as a transferor, then the details should be provided. Nature of proceedings, statutes of the same and company's dues on the same also has to be provided in the notes to this company. So normally, almost all the companies have current cash credit facilities from banks, and companies normally submit monthly stock statements and debtors, receivables to the banks on a monthly basis. Now, what this disclosure has brought in is, now the company has to disclose in this notes whether the quarterly returns or statements of current assets filed by the company with the banks or financial institutions or agreement in the books of accounts. So this is a very, very critical change which has been brought in, which brings in a lot of transparency and also a lot of responsibility on the companies to give the proper statements for banks. And, and if there are any differences between the books of accounts and the statements which have been provided to the banks, so the company has to provide a reconciliation and also has to provide why the reasons if any, in case of material discrepancies. So this is a very important change which has been brought in. Next is whether the company is declared a willful defaulter by any bank or financial institution or other lender. If a company is uh, declared as a willful defaulter by bank or any institution, the following details shall be given by the company. So one is date of declaration as willful defaulter by the bank, and on what account default has been made. The nature of default, the amount of default also has to be declared in the notes to accounts. Willful defaulter here means a person or an issuer who or which is categorized as willful defaulter by any bank or financial institution or consortium thereof in accordance with the guidelines or willful defaulters issued by the Reserve Bank of India. The next important disclosure which has been brought in uh, by this amendment to Schedule 3 is if there is any, if the company has any relationship with struck off companies. So a lot of companies were struck off by MCA under Companies Act 2013. So now the companies have to disclose whether it has got any kind of relationship with those struck off companies, and the nature of relationship, like investment in securities, if it has to receive any money or it has to pay any money, any other outstanding, and what is the nature of relationship with the struck off companies, it has to declare. So this is going to be a challenging task because a lot of companies have been struck off by various ROCs. So the companies have to go in and see which companies have been struck off and give these details. So the next important change which has been brought in is with regard to registration of charges or satisfaction of charges with the registrar of companies. Any charge or satisfaction which is yet to be registered with registrar of companies beyond the statutory period has to be disclosed, and what kind of charge it has not registered or satisfied, and the reasons thereof for not doing it within the statutory period also needs to be disclosed under this note. So the next important change is the layers. Whether the company has, where the company has not complied with the number of layers prescribed under clause 87 of section 2 of the Companies Act, read with Companies Restriction on Number of Layer Rules 2017. If it is not complied with, then the name and sin of the companies beyond the specified layers and the relationship, extent of holding of the company in such downstream companies shall be disclosed. So then another important change which has been brought in by this uh, amendment to Schedule 3 is a lot of ratios needs to be disclosed as a part of this. One is current ratio, debt equity ratio, debt service coverage ratio, return on equity ratio, inventory turnover ratio, trade receivables, trade payable to turnover ratio, net capital turnover ratio. So many ratios has to be disclosed in the notes to accounts now, and the company also has to explain what it has taken in the numerator and the denominator for computing these ratios. And also the company also has to provide if there are any more than 25% change as compared to previous year, the reasons for the changes also has to be provided by the company. The next important change which has been brought in is with regard to compliance with approved scheme of arrangements, where any scheme of arrangements has been approved by the competent authority in terms of section 230 to 237 of Companies Act 2013. The company shall disclose whether the effect of such arrangement has been accounted for in the books of the company in accordance with the scheme, uh, or if there is any deviation in this regard. And if there is any deviation, it has to be explained why such deviation has been made while accounting these merge schemes of arrangement approved as approved. So next important change which has been brought in is additional utilization of borrowed funds and share premium, where a company has advanced or loaned or invested funds in entities, including foreign entities, with an understanding that it shall be an intermediary. That means the company to which the loan is given will invest in some other companies or lend or give guarantee. Then the company which is giving such loan or investing funds has to give the following disclosures: date and amount of fund date and amount of fund advanced or loaned or invested in intermediaries with complete details of each intermediary, date and amount of fund whether advanced or loaned or invested by such subsidiaries to other intermediaries or ultimate beneficiaries along with complete details of ultimate beneficiaries, date and amount of guarantee, security or like provided or on our behalf of the ultimate beneficiaries. And the management also has to give a declaration that the relevant provisions of Foreign Exchange Management Act 1999 and the provisions of Companies Act and provisions of Money Laundering Act has been complied with. So this is a very it seems that this provision has been brought in to discourage uh, pass-through entities for funding or giving loan or investments. That is what I feel. And the companies which receive this money for the purpose of investment in the downstream companies or on behalf of ultimate beneficiaries, they also have to give disclosures in their balance sheet how much funding they have received and where have they invested or what guarantees have they have provided on behalf of the ultimate beneficiary, and also declaration that relevant provisions the company receiving this loan, investments or guarantee also have to make a declaration that relevant provisions of Foreign Exchange Management Act, Companies Act have been complied with or for such transactions, and they are not violative of Prevention of Money Laundering Act of 2002. So these are the very important critical changes which have been brought uh, in the form of new additional disclosures which have to be made in Schedule 3. And these disclosures, except for these ratios which are slightly different for NBFC companies, all the companies, whether they fall under Division 1 of the Schedule 3 or Division 2 of the Schedule 3, these uh, disclosures have to be made. And the next change which has been brought in by this amendment to Schedule 3 is uh, in the statement of profit and loss account, the terminology used was total revenue. Now that has been changed to total income. So the next important change which has been brought in is if there are any grants or donations received, and this is relevant only Section 8 companies, it has to be disclosed separately. It cannot be disclosed in other income or other as normal income. It has to be shown as a grant or donations received separately for this. Then one more important information which has to be provided is if the company has gone under any surrendered any undisclosed income to the income tax department which it has not recorded in its books of accounts under any search or survey, it has to disclose in its books how much it has surrendered or disclosed income during the year, and how it can be either income, assets, and whether it has been properly recorded in the books of accounts during the year, and how it has dealt it in its books of accounts. So this was not there earlier. Now this is a new change which has been brought in. And one more important disclosure, which is the hot topic currently now, CSR. So now this disclosure earlier was only there in the board's report because it earlier the CSR provision was you comply or you disclose, explain why you have not complied or why you have not spent. Now this has been made mandatory with the amendments to the rules. So now the directors, in addition to whatever they were disclosing in the director's report, in the financial statements also the company has to disclose where the company, whether they are covered under the CSR provisions, the amount required to be spent by the company during the year, the amount of expenditure incurred, shortfall at the end of the year, and total of previous year for shortfall, reasons for shortfall, nature of previous activities undertaken, and details of any contribution made to related parties in relation to CSR expenditure. For example, if the trust is again controlled by the company, how much it has made the contribution to related parties, and whether any provision is made in respect of liability incurred by entering into a contractual obligation. So these disclosures also have to be made in the notes to accounts, in addition to this thing, board's report. And also one more important additional information which has to be provided in this notes to accounts is details of cryptocurrency or virtual currency. Whether the company has traded or invested in cryptocurrency or virtual currency during the financial year, the following has to be disclosed: profit or loss incurred on transactions involving cryptocurrency or virtual currency, amount of currency held as at the reporting date, deposits or advances from any person for the purpose of trading or investing in the cryptocurrency and virtual currency. So, so I have summarized all the changes which have been brought in the schedule 3. So these are the major changes which have been brought in. So with this, I close my presentation. Sir, over to you, sir.
Yeah, thank you, Raghuveer, for setting the tone for today's panel discussion. I think that was very much required by you. So let me welcome our panelists. Can you remove this screen, Raghuveer?
Yes, sir.
So welcome to all the participants to this panel discussion on Schedule 3. I'm sure there are n number of questions in the mind of each one of you. I have seen a lot of queries posted on the chat box also. We will take each one query. Let me acknowledge the presence of very senior company secretaries. I can see the name of Bharat Vasani ji and Sudhakar ji and Mr. Mehta and many other. So thank you for this encouragement of the initiative of CII and CLA for sharing the updates and the making discussion on the relevant concurrent issues. The panelist for the today session, Mr. Raghuveer, Mr. Pramod Jain, Chartered Accountant, partner of Lunavat and Company, and also a Central Council member. He would be joining in another 10-15 minutes time. He's in another session. And my dear friend, Mr. Anshul from Reliance Industries Limited, Tirupal from Bangalore, so with this background, what Raghuveer has just now discussed with regard to the recent changes what Companies Act 2013 has made in respect of Schedule 3. Let me ask a question. Maybe Raghuveer, you have since dealt with this subject just now. So if I can ask you to make me understand what was the necessity of bringing these changes, because as I am able to understand, these changes are essentially to align the provisions of the CARO.
Yes.
Government has already announced the new CARO. The implementation was deferred. However, government wanted the changes to align the same in the disclosures in the balance sheet as well. That is one thing which I am able to understand. Then there were, I can compliment to the government for one good reason, that for the first time I am seeing that the regulatory changes have been incorporated in the Schedule 3 balance sheet itself. So somewhere they have made it mandatory, or they have devised a mechanism of monitoring the regulatory compliances through the Schedule 3 as well. To what extent you agree with this, and how you see this change? Can you throw some light on the background, and then we will hear the views of the other panelists as well.
Yes, sir. As you told, the CARO 2020 was brought in. So these changes, the chartered accountants, the auditors basically were of the view that the onerous responsibility of certifying or telling the true and fairness is only on these informations, especially was put on auditors without responsibility being put on the company, who are primarily responsible for these disclosures. So government, based on those feedbacks, also thought it correct that it has to first come from the company side, and then the auditors can uh, certify it as true and fair in their audit report on based on their audit procedures. And one more thing, what I can say is, many of the things which has been brought in were treated as good practices, like disclosures, accounting ratios. So these were treated as good practices to be followed. Now what the government is doing is, good practices are being brought in to the regulations itself. So that is one change which the government is making. And with this disclosures which are being brought in, a lot more transparency is also getting brought into the financials, especially from funding for the banks. Many of the banks, these stock statements, many of the companies, from my experience, I can tell, were giving something to the banks, and something which was not exactly in their books of accounts. So now with these additional disclosures, all those kind of things at least will get highlighted. I don't say it will be totally curbed. At least it will get highlighted. Some responsibilities fixed on the company and also the auditors. So this is the basic intention, that the banks and other stakeholders who are involved with the company should get more information, correct information. So I think this is the intention of the government in bringing these changes into the regulation itself.
Yeah, Raghuveer very rightly captured. Just to add, what I also understand, I can see while you were explaining the changes, I can see there are a lot of changes which are result of COVID. There are certain changes which are result of insolvency law. There are certain changes which are result of the changes what the government has done in the previous period, like the drive was done by which the lot of companies were struck off in 2017-18. So government is also trying to extract lot of information by way of this change that the government has proposed in the Schedule 3. Tirupal, what is your view? What could be the other reason for understanding why the government is doing all these changes?
Yeah, see, as per my view, if you look at these, the data which they are asking, uh, fundamentally the company themselves are not maintaining in-house. Like you take the section 187, companies where they put their money and they acquire the assets. However, the assets are not there in the name of the company. Despite of that, you don't find any register having the details. I've seen many companies, like even subsidiary company shares. Sometimes even last month I had installed, acted as a resolution professional, also insolvency liquidator. I found that the asset is there in the books, but is not there in the register. When I asked him, they said that that particular asset is registered in the name of the director. However, in the books, because the money was paid, it is shown in the fixed asset side, but it is not there in the register, and no title deed is found, especially the car, the luxury cars, so many things are, I've seen. So it is a good paradigm. And then syncing with the what is shown in the balance sheet, now the company should go back, maintain, set right their houses, then report it to the stakeholders. It may be to government, it may be to whoever it is for that matter. So it is a welcome change. I feel it may be the reason now we professionals should be very clear about it while certifying, while bringing those things. We should ensure that yes, this is there in the company and this been produced in this financial statement as part of disclosures.
All right, Trupal, just taking it forward, there is a lot of debate which is going on, lot of confusion is going on because the notification of March 24, 2021 does not very clearly specify as to for which financial year this provision is going to be applicable. Whether it is financial year starting from 1st of April 2021 or any financial statement which is prepared after 1st of April 2021, it is going to be applicable. Because if it is any financial statement which is prepared on or after 1st of April 2021, then I think there are a lot of companies which are preparing their financial statement by April itself, and they disclose in the stock exchange by way of financial result. So they would be having a lot of challenge. I don't know what is the intent, but we can understand that the changes are in alignment with CARO. So the other interpretation is also possible, but it is not very clear. What is your take on that?
Yeah, see, if you look at the other notifications and the notification for the schedule, amending the schedule, they have not used anything like a for the financial year. They simply said with effect from 1st April 2021, the changes will be effective in your balance sheet. See, I have a different view altogether. Okay, excluding the companies which are listed, which are supposed to prepare the quarterly financial or half-yearly financials. But look at the balance sheet of the other companies. They technically, sit on after the 1st April to prepare the balance sheet. The one question, when I sit on the 1st April 2021 to prepare a balance sheet, when I open the Companies Act 2013 and I see the schedule, I found the schedule with the new figures, new disclosures. And moreover, this particular disclosure or schedule, whatever it is there, is under section 129. It is not under section 128. 128 is all about the cooking the books or preparation of the books, all those stuff, which is a continuous process from right beginning the financial year. Whereas you look at the section 129, this schedule or the disclosure, whatever you are making, is like a information that you are providing, more information that is already pre-exist with you. So as per my understanding, even I had debated this issue with other colleagues also, it appears to me when preparing the balance sheet for the year 2021, you may need to draw the balance sheet or the schedule or the disclosures, whatever it is, as per the the day when you are drawing that, you are drawing as on so and so date, what it says. So from today onward, this is the so and so table, this is the so and so disclosure, this is the so and so map that you are supposed to provide, and extra information you have to provide. For this, you don't need to maintain the books altogether. It is an extra disclosure. I feel it should be, and moreover, if you look at those postponement circulars with respect to the auditor and also the accounting, audit trial software. But all the circulars came at the same time. However, the two cases they could notify saying that it's going to be applicable for the 21, 22 onwards, not the 21 onwards. So there are two contradictory views. But as per my understanding, 2021 itself, I think you may need to provide these disclosures in your balance sheet while preparing by the company.
Rupal, while I agree with your view, because that seems, unless ministry clarifies that it is other way around, till that time, I think, yes, that is a very much possibility. The way you are interpreting the things, I'm in agreement. And even though, if we take the other view also, in any case, you have to prepare the previous year figures, even if it is applicable from the subsequent year, let's say, then in 21-22 balance sheet, you will be required to have the figures of 2021. So in any case, you need to have the data for the current year. Maybe it is used in the current year financial statement, or it is in the subsequent financial year. But I'm sure a lot of professionals who are participating in this program today are going to have a anxiety over the statement what you have made. Let's hear the view of the Anshul also.
Yeah, probably when I inquire with the some known resource, when the 2 or 3 circulars were postponed by giving the amendment to the effective date, why the amendment date was not notified for this particular schedule 3. I got an answer, but unofficial. They say that it is written clearly the 1st April 2021. So you are required to apply this particular schedule only from the FY 21-22. This is the answer I got it. That is the reason ministry did not come out with any amendment notification like they did in for other 2 or 3 cases. This is the information I got it, but I can't give any source for that. But I got this information.
Yeah, I can very well understand, but better is that ministry should come out with a clarification so that the people don't have any doubt on that. Let us hear the view of Anshul Jain also. Anshul.
Yeah, good evening, everyone. First of all, thanks for inviting me for this panel discussion. And I start with, since it's a critical question, so let me start with a disclaimer that whatever I'm going to give, it's absolutely personal views, that there is nothing to do with the companies to which I belong. It's very difficult to, as far as the plain reading of the notification is concerned, it's very difficult to say that this will be applicable from the balance sheet date 31st March 2022. So I completely agree with whatever Tirupal has said. But of course, it has its own challenges because the notification came at a very last moment of the financial year, and in any way we have to prepare the comparable statements for the next whenever we will prepare whatever view will take. In any way we have to take a comparable figures. Now assuming for a moment that if I am going to take a view that it is applicable effective from balance sheet effective from March 31st 2021, because I will be preparing my financial statement after on and after 1st of April, then what will be the comparative for the previous year? Are you going to give that or not? So that is going to be a very challenging task, realignment of the entire disclosure, whatever we have made last year and whatever we are going to give this year. So practically, if I look at, because I have also seen the notification issued on this CARO 2020, where the government has extended it. So similar kind of wordings are used. So we can take a view. Of course, this view can be taken that it should be applicable effective from balance sheet dated March 31st 2022. However, better if we can get some kind of clarity from the ministry on this subject. Not only this, whether it is applicable whenever it is going to be applicable, that is one part. But my one important element with regard to this disclosures, that we have to, even if we are going to adopt, say, from next year onwards, but we have to work from today onwards on this kind of disclosure, because the kind of disclosure these are not going to be decided across the table sitting in a one day and we'll close all the matters, say sitting in the April 2022, we'll decide and we'll close it. It will require a lot of preparations. So we have to, whether from regulatory perspective, whether you disclose it or not this particular year, but I think we should also at the same time try to prepare after closure of our activities. We should sit and we should prepare the financial statement based on these disclosures, because this will set a tone for the next year preparation, as well as wherever we are stucking, that can be sorted out right now. And there are certain disclosures which may be uncomfortable for any of the company if it is uncomfortable to give, so they can work on those things. So lot many things can be done before closure of the next financial year. So my take is that whatever date you select, but start the working from today itself.
Yeah,
But better
Anshul,
the
I think,
government should give the clarity on this.
yeah, maybe government will definitely come out with the clarity. But one message that is for today is very loud and clear, that Schedule 3 amendment is a reality as on date. And we have to learn how to make these disclosure. Maybe at max, the effort that you do today to prepare these additional disclosure will not definitely go into vain, because in any case for the next year disclosure also these preparations are required in any case. If it is clarified, then so far so good. Raghuveer, if you have got any different view, then you can come in. Otherwise, I will park this issue because this is a very relevant issue, and I would like to hear the view of Pramod Jain ji also, who would be joining in next 3-4 minutes. We'll come back again on this question. Raghuveer, if you have any
No,
different take.
I don't have a different view, sir. I think.
All right, all right. So, Anshul, taking the discussion forward where we left, do you think there is any type of company, because it is applicable on Schedule 3, all three division 1, division 2, division 3, whether it is a company which is following the accounting standard or Ind AS or the NBFC? Is there any company, although I am not able to find out and understand, that any company on which this provision will not be applicable? Because this is another common question which a lot of professionals are asking, whether it will be applicable on a small company or not, whether it will be applicable on a private company or not, though there is no distinction. But I think your words will make a lot of difference and give a clarity.
I of course, I even thought on this particular aspect, but I could not find any kind of company. The only statement which I can make for this particular question which you asked, that if at all any company which is governed by any specific law, and that law is overriding Companies Act with some specific provision that the financial statement is to be prepared in this particular manner only, then only you can skip from Schedule 3. Otherwise, I think these are applicable to all kind of companies, and no distinction per se based on the class of company, like you said, a small company, private company, something like that. No such kind of distinction is made.
Okay, all right. Tirupal, Raghuveer was making one remark, and one significant change is shift from the disclosure regarding the shareholding. Presently, as we know, that only the shareholders who are holding more than 5% are required to be disclosed in the balance sheet. Now, the proposal is that the promoter's holding is required to be disclosed. Means if I have got 10 promoters, and even if one promoter is holding, let's say 1%, even that percentage is required to be disclosed. So what is the rationale behind this making a shift from disclosure of more than 5% shareholders then to the promoters list in the balance sheet itself, whereas we all know the percentage of holding is very well available in the MGT 7.
Yeah, see that MGT 7 basically, of course, as per latest amendment, is supposed to be part of the board report, and board report is also an attachment to the financial statement. So erstwhile somewhere you will get already the information. Now probably they want to have the gathering of information instead of scattered information here and there. They want to have the promoter who have been defined as a promoter under MGT 7. They want to recognize the same in the balance sheet as well. Here maybe they want to identify exactly, instead of significant shareholder over and above 5%, they want to have whom you can call as a promoter among them. They want to bring out probably, I can give one example, like you look at the section 42, there is a concept called promoter. Again, for non-compliance of various section, promoter word has been used. Maybe remotely, they may come back to the balance sheet and say that you have already disclosed yourself as a promoter, then you will be held responsible for the non-compliances of various sections. So this may be the reason, but technically they are just gathering one step, ahead to the 5%. 5% is basically a kind of a significant holding. Now they want to know that a grouping of those 5% into a promoter concept. It is just one step ahead, and which is already, as you rightly pointed out, is available at MGT 7 or earlier MGT 9. So I'm not finding much, but they're just gathering more information.
Thank you, Tirupal. I think I'll come back to you again on this question. Let me welcome Pramod Jain ji, who has joined, and he is definitely an authority on this subject. So we had been waiting for his joining. Definitely we'll have the clarity. Welcome, sir. We have just, you have entered at a very right time. We have just begun the discussion, and we were struggling to understand the one fundamental question that this change has came on 24th of March 2021, and the notification as it goes, it does not give a clarity as to whether it is applicable for the financial statements prepared on or after 1st of April 2021 or the financial year starting from 1st April 2021. So we have heard the views of the other three experts as well. We would like that you give a clarity, and we are assured that yes, we have to follow this. Please, sir.
Thank you, Amit ji. Sorry for joining late. I was stuck somewhere else. And this, if I talk about the Schedule 3, whenever there is a format which is prescribed in Schedule 3, all the three divisions, Division 1, 2, and 3, it tells about the date of applicability, that is the year from which the accounting period starts, that is the date. So in this amendment also, they have given the date of this amendment to be 1st of April 2021. So any financial statements prepared for a period starting after 1 April 2021 has to comply with this Schedule 3. This is my view. And another view, if you see, most of the amendments are related to the disclosures which are required to be reported by the auditor in the CARO. And that CARO is applicable for the audit for the financial year 21-22. All these disclosures which have been made, these changes have been made, majority of them are related to the disclosure for CARO.
So we take your view as a notification from the MCA, and I think
yes, sir. It is everyone's view.
So blood pressure of lot of professionals might come to normalcy, which has shattered up and down for last 5-7 minutes. But I think yes, I'll agree with you. But we were not able to read the way your expert eyes were able to read this Schedule 3. That is why it is called experts domain. So, sir, we understood that. And second point that we were deliberating, is there any class of company for which this amendment or Schedule 3 would not be applicable? Because as I understand, part Division 1 applicable on accounting standard compliant company, then Division 2 for Ind AS company, and Division 3 now for NBFC as well. Is there any other class on which this will not apply? Only I think one class can be possible, which are special legislation companies on which Schedule 3 itself is not applicable.
Very rightly said. Otherwise, to all companies, it would be applicable. You're very rightly said.
All right, sir. So we move to the next point, which we were deliberating, in fact, while you had joined. That was regarding the disclosure with regard to the promoters holding. So Tirupal was just giving a clarification. I think government wanted to gather all information at one go, and it has got a lot of repercussions also. Do you think because under the insolvency law also the promoter has some meaning? Are they trying to fix the responsibility and onus on the management that whatever you are disclosing in the financial statement will be taken as a authentication from the side of the management that yes, you have declared that so and so person is a promoter? But otherwise, what is the logic? What is the rationale behind? Because we have already the disclosure of list of promoters and their holding in the annual return, that is MGT 7, and that is also in public domain. Just by adding one more information in this particular balance sheet, what else could be the logic?
My view out here, Amit ji, you must have all discussed that very fine. Uh, the intention, what I feel so of the ministry is to make the financial statement be more meaningful to all stakeholders. So whatever they think are important for the various stakeholders, whether they are regulators or investors or dealing with those entities, they should be aware of those facts. They did not go to an annual return. They are not that savvy. But several entities share their financial statements and not the annual returns. So they don't know who are the promoters. Because because the definition they have to take is purely as per Companies Act and not as per the IBBI law or the SEBI law. It has to be as per the Companies Act specifically mentioned. So when it has to be as per the Companies Act, the promoters which has been defined, which is given in the annual return, but what is the change in their shareholding during the year? That is also required to be given. So they want all the information at one place. They want to know to the stakeholders that total percentage of shareholding, say, is 100%, out of which more than 5% disclosure is only for 20%, and the promoter shareholding is only 2%. It can be that way.
All right.
It can be. It is not that he's controlling majority of shares, so he becomes a promoter. He may not be. He may not be. A case can be there. So depends on case to case. So they want the information out there. This is my.
Yeah, absolutely, sir. I can correlate with the logic and otherwise as well. Raghuveer, there is a requirement for making disclosure regarding the loans and advances to the promoter, director, key managerial person, and the related parties, which are already in terms of the accounting standard. Now, there is a separate disclosure, which is now again required to be made, as you were also highlighting. Why? What is the necessity? Because in any case, when I am complying with the accounting standard, I am making that disclosure with whom, which party I have taken the loan or given the loan. In any case, that is part of my notes, and I am disclosing. Now, additional disclosure in my balance sheet also is required to be made. Do you understand what could be the logic behind doing that?
Sir, in accounting standards, we don't disclose. We disclose all types of loans, but here there is a very specific loan where there is a loan which has to be disclosed. That means where it is repayable on demand or where there are no terms specified for the loan. Only those kind of loans are to be disclosed here. So these kind of loans.
Yeah. Please go ahead. Go ahead.
What happens is if there is no term specified, it keeps rotating with the directors and there is no accountability for that. So if this kind of a disclosure comes in, I think there is more accountability for the directors who takes the loan or relatives or the companies when they give these kind of loans. I think that is the main intention. And also in accounting standards, we don't disclose what is the percentage of these loans to total loans and advances. Here, that percentage also is being asked. So that gives one more information to the stakeholders in the company.
Yeah, great, Raghuveer. I think that brings a lot of clarity. I was not able to, while doing the reading, I was not able to understand why this distinction, but I can understand the logic that you have given. Sounds very nice. Pramod sir, one very big change that I can see, I think I would like to hear and deliberate a lot more on this particular point, that is trade payable and trade receivable. A big Pandora box has been opened, and the more we talk, I think more we get into understanding this particular subject. I can see it from many dimensions. So just can you highlight, because the participants can also understand what exactly is the change in the trade payable, trade receivable.
Thank you, Amit. On one of the last points which you said about the loans and advances, important point out there is it is not loans and advances received, but loans and advances granted. not received but granted, and then percentage thereof. Point number one. Point number two, yes, very rightly said that it is either repayable on demand or without specifying any terms, the period of repayment. That is not required to be disclosed on the other disclosure which are already made. The other disclosures which is already required to be made for the loans and advances given is as per AS 18 as well as section 186 subsection 4. But here, this requirement here is just for the company to inform this and further the auditor to reply on the Caro report, because again the same thing has been asked from the auditor under Caro clause 3F. So coming into the notes and the auditor ensuring that that has been disclosed. So that has been brought.
I think
Now,
lot of correlation has been created from the Caro, and lot of
yes.
things are brought in this schedule 3 from the Caro, so that
Yes.
I think auditor is also compelled to make a reporting thereon and give their comments.
Yes, Amitji, because you see in the Caro they have said whether the company has disclosed this or not. So they had to bring that into the schedule 3 so that auditors can reply whether they have disclosed or not. So all those things. Now, talking about this trade payables and trade receivables. Yes, fully agree with you. One of the very, very important changes, and it is going to shake the whole industry. Especially, I will talk about whether it is listed or unlisted, private or public, whatever it is. Because till now, in the trade payables, if I talk about first trade payables, the disclosure was only related to MSME and other than MSME. Now the disclosures that is required is much, much beyond that. Now, if I talk about trade payables, they are asking for the aging which is less than 1 year, payable 1 to 2 year, 2 to 3 year, and 3 year and above. And very important out here. And again, to MSME, non-MSME, trade payable which are disputed, MSME, and undisputed. So when a trade payable is disputed, so is it still payable? And when it is undisputed and still it is payable beyond 3 years, what is the reason thereof? The management will have to answer it. The auditor will have to seek it. And more importantly, when the year of 22, March 22 would be given for the financial statement 22, the previous year figure for the 21 would be given. So I have been saying in so many seminars out there, and shared a small video also on this. Basically, when you are not seeing in 21, in 22 there would be a big issue. So simple example, suppose there is a trade payables of 10 crores, which is beyond 3 years. So you say it is schedule 3 for March 22, very fine. So when you prepare the financial statement for 22 and you give the previous year figure for 21, you say, okay, the 10 crore was payable even in 21. So what was the reason? Or if you see, okay, it is beyond 3 periods and you try and pay that off in 22. So reduction from 10 crores to 2 crores. So reasoning for them to whom it is paid. So all that need to be looked into. So why it is still payable, then confirmation of all those people, why it is not written off that it is not payable, the limitation of bar, the time limit would be there, the time limitation. And similarly in trade receivable, where we have been giving about the due amount due from the date it is due, from the due date of payment, beyond 6 months and less than 6 months. Now, and then doubtful and good. Now it is even disputed, doubtful, and even unbilled dues, aging thereof, below 1 year, 1 to 2 year, 2 to 3 year, 3 year and above. If it is beyond 3 years, is it still receivable? You are saying it is still not doubtful. Why it is not receivable? Beyond 3 years, have you gone to IBC for that? Why not? If it is beyond 3 years and you are saying it is undisputed, so why it is not received? Is it from an associated enterprise? The reason thereof. All these things need to be asked by the management, also have to see, and the auditor will also have to answer this. So these disclosures are really, I would say welcome, because this is really going to change the whole scenario.
Yeah, logically, I also fully agree. And after these changes were made, so I was always wondering why these disclosures were not there earlier. These disclosures were essential. Means, of course, they are very essential. But I was failing to understand. Correct me in my understanding. Is this COVID 2019 reason of government benevolence of extending the period of 6 months and more than 6 months period to up to 3 years disclosure are required? Now, previously the disclosure were only in two baskets, which are recoverable in 6 months or which are beyond 6 months. Now you are saying up to 6 months, 1 year, 2 year, 3 year, and beyond. So is that because government is thinking that because of this COVID, business cycle will be affected, economy will be affected, so the loans will or the money will not be repaid in long-term period? Is that, or is, if you are thinking something else as well?
No, Amit, I don't think so. It is all related to COVID. Nothing related to COVID, because these changes were suggested prior to COVID also. In last year, they were supposed to change the schedule 3, but due to some reason or others, they had to extend it. And basically, if I talk about, one question, it would be, when it is doubtful more than 3 years, why a provision has not been made? Provision for doubtful debts.
Yes.
All this basic, having that a stakeholder who is going to transact with the company should know that how is the nature of the company when they are receiving the payments, because the ratios, when you talk about, they will be talking percentage to the total sales of the trade receivables, trade payables. So how much of the amount of my total turnover or purchases I keep at pending paying? So how good I am a paymaster, how good I am a collector in my business. So when I'm interacting, I'm transacting with the company, I should know how are their internal controls regarding to receivables and payables. The overall, it would be beneficial to all bankers and other stakeholders.
Absolutely, absolutely. Just one more angle. I'm a insolvency professional as well, so I was reading these changes from that perspective also. I think you also highlighted. Now, once I have shown it in the disputed category, or the other person has shown in the disputed category, and it is an operational creditor case. So both ways, I am cutting my rights or I am creating my own safeguards. Right? If it is, I have to receive and the other party has already shown it as a disputed, then I'm gone. I don't have a option that he will prepare. He will just file that my balance sheet that he himself is saying that this is disputed. Will this be admissible as a evidence before the court of law? That is what, because now
No.
you are going to
merely disclosing as a disputed, Amitji, could be a trouble unless you have to evidence further with the dispute, whether you have gone for any court of law or arbitration, whatever it may be. It has to be further evidenced. The communication with each other regarding the dispute. And again, basic thing is first management, second the auditors. So more duty has been casted upon the management as well as the auditors. So it would be a good.
I was coming from a little different perspective. I will give an example. Let's say there is a supply from one of the vendor, and I am a OEM manufacturer, and I have not made the payment to him, and the reason being that because the quality was bad, and I have already written a communication to him that, boss, you have supplied the substandard goods and we will not make the payment. Can we say that there is an exchange of communication in between the vendor and the buyer? Will this suffice for the auditor to take a base that this is disputed? Or will you consider that unless and until the matter is litigated and it is either before arbitration or any civil court, you will not consider it as disputed? What will be the basketing of dispute or undisputed? Because it is very difficult to believe, because the NCLTs would be very much eager to take the statement on oath, what is disclosed in the balance sheet. They will say you yourself are disclosing it as a disputed one. So how you can go against that? Only limited point that I just wanted to make. If you think that any precaution or care has to be taken with that regard.
Can someone guide me? What is the exact wording given in the MSMED Act, where the payment is to be made within 45 days, and the word is within 15 days if you raise any objection. So
Yes.
what you are telling is an objection, that is not a dispute. Dispute has to be in any court of law, in my view. It is just an objection and then reconciliation. So merely communicating those objections is not a dispute.
Pramod sir, but there are, if you see the Mobilog judgment in insolvency on the, I'm although dragging a different issue, but since point has came, in Mobilog judgment, Supreme Court has said it is not necessary that dispute should be only in the court of law. It can be otherwise also. Maybe I have not gone to court at all, but still it will be a dispute. So maybe we will discuss that issue, I think, at a separate forum when we discuss the insolvency issues. I think let us take it forward. I think we have understood that a lot of basketing is done, undisputed and disputed, trade receivable, trade payable, aging of 6 months, 6 months to 1 year, 1 year to 2 year, 2 year to 3 year, and 3 year or more. So I think a lot of challenges would be there. One last question on this particular part. I have seen one new terminology that is called unbilled dues. What is this? If I am saying means I have an option of receiving the bill, but still I can say no, it is unbilled. I was discussing with one of my colleague who is working in one of the corporate. He was saying the practice that we are doing is we recognize the bill only when it comes to accounts department, and it comes to accounts department only after quality check. So you receive the bill today, 10 days processing at a quality will be taken. And once the goods passes the quality test, then they will be submitted to the accounts department from where the time starts. So is this period recognized for the unbilled, or you can guide us what exactly is the meaning of this unbilled dues as well?
This is related to trade receivable. And basically, if you talk about, this is for the service industry. And there is accounting standard 9 for a percentage completion method, that if the specified percentage is completed, but the exact point has not come where you have to raise the revenue. But as per the accounting standard, you have to recognize the revenue. So that is recognized as a revenue, as an unbilled revenue. So when it is unbilled revenue, recognize that in your profit loss. You say unbilled revenue, you charge it to income, and that because you have not billed, that is a unbilled dues. So now they want out here that if you have to give the aging of the unbilled dues, कहीं ऐसा तो नहीं है कि कोई unbilled dues more than 1 year चला रहा है. So why you have not billed? So aging of that, it is related to purely service industry.
So nothing to means be relating it.
It is receivable, debtors.
Acha, because we are discussing any idea what is the practice prevailing and what is the correct methodology, because the MSME Act is talking something on a different line for the period of 45 days from the time from where the 45 days time will start. What is the correct accounting principle, we'll say, from where the 45 days time should start? Let's say I'll give you one case in hand. Let's say I have provided a service, but I have not raised the invoice, because the language that the MSME Act uses is different. Now, so unless I make the invoice raised to the company, there is no occasion for the company to make the payment to me. So in such cases where the invoice is coming late, or invoice is not getting processed because of their internal barriers and checks, will that period be included in 45 or excluded? What is the practice and also the correct principle? I think a lot of participants would be benefited if you can have your view on that.
Two things. One is Anil Joshi ji has said that this happens of unbilled revenues there in construction industry. Construction industry is also service industry. There it is my AS7, or if I talk about income tax, ICDS 3 and ICDS 4 for construction and both service industry. Real estate industry, it is not unbilled revenue. Real estate software is again service industry, no? So their milestone based completion, that is unbilled revenue. Real estate, that is if I talk about, if I am a builder, then it is percentage completion method based upon the advances received. So that is not an unbilled revenue. That is based on the advances received. The question which the discussion which Amit ji has talked about is MSME. You know, MSME, my starting point is when I have received those goods or received those services, and the invoice has been raised upon me. Because unless the invoice is received by me, how can I make a payment? Now here, the point is invoice is raised upon me. Now it happens at certain places in a bigger industries where the invoice is raised and they've got a receipt at, say, the shop floor level or the godown level, and the godown level person takes time to hand it over the account department. So there it is a practical issue. There it is a practical issue, and they need to speed up, because the moment it is accepted by the company at any of the places, the moment of the MSME starts, right? So that way it has to be calculated 45 days from there, and then 15 days within which they have to raise an objection. Otherwise, 45 days started from there. This is my view.
All right. Raghuveer, you were talking about additional disclosure in relation to the borrowings that are made by the company from the bank and the financial institution. Anything that you can guide further why these disclosures have been added and how the industry and the banking and the other people are going to be benefited out of that? I can certainly understand the few of the logic, but I think it would be better if you can explain.
Basically, this is applicable. This happens in case of term loans, which are given with an end use. So, in end use, this new provision says that you will have to say if you have not used it for any of the purpose for issue, it was not used for the purpose it was given. The bank has given the loan. So this additional disclosure, the board has to be, or the company has to be extremely cautious when they make use of the funds which has been made available from the bank. So to bring in that responsibility in the company, and also to the auditors, to give the auditors a comfort, because they also have to report in the CARO. So I think that is the logic with which this disclosure has been brought in.
All right. Tirupal, currently only listed companies are required to make disclosure regarding the current ratios, certain ratios, not current ratio. There are certain ratios which are required to be disclosed. This we witnessed, I think this is a last 2-3 years back regulation 34.3, if I'm not wrong, and read with schedule 5 of the SEBI LODR. These disclosures are required to be made. Now, all of a sudden, government has added almost 11 ratios. And not only the 11 ratios, but they have also mandated that we have to tell how the numerator is built, how the denominator is built. Let's say current ratio. So what you are taking in a current asset and what you are taking in the current liabilities, that also you have to explain. And any time if 25% plus or minus happens in the subsequent balance sheet, then you have to give a justification also. Now, so are we saying that government is creating a new monitoring mechanism, or you can say it is a way forward that e-scrutiny mechanism that the government has devised. They will be putting these parameters on the radar, and any changes beyond the particular number will automatically put to the scrutiny and all. Are you in agreement, or what is your take on that?
Yeah, see, maybe, sir, when I was a student, I was wondering because none of the balance sheets were having any of these ratios except the project report that I give to bank or financial institutions. I was wondering why this ratio was so important when sanctioning a loan, sanctioning a facility to the industry. Why we were not reporting in the regular balance sheet so that the people like various investors also can look at those ratios and can make calculative decision whether to invest into the company or not. So I was wondering. So I think this is a good move. They brought in at least 11 ratios, which are very crucial for the industry to analyze the balance sheet. Is like a ready-made food that they are providing based on your figures that are there in the balance sheet. Now, technically, because in the industry standards are there, what could be the current ratio, what could be the debt equity ratio, what could be, these are the standards are available, and the comparison also will be very, very easy. And of course, as you rightly pointed out, even that e-scrutiny cell certainly having the parameters to identify any deviation out of these things and to question the company, and company must be in a position to explain, right, being numerator, denominator, or previous year, current year, 25%, and all those things. They are all basically trigger points, as I understood, must be trigger points for the scrutiny, maybe to take out and ask for the further information. Instead of using section 206 to gather the information per company to company, now the government is collecting information at the front of the balance sheet itself.
All right. Jain Saab is there. So are we, because the challenge, Pramod sir, I am able to see because all these ratios we have understood, we have read in the financial management. Now, when I was a student 20 years back, today also I am a student only. So that time we were reading all that ratios in books, that this is a current ratio, this is a debt equity ratio, this is, but there is no standardization. When even we go with the bank also, certain bank CMA data will say, no, this I will not include. My banking policy says that the ratio has to be calculated, the debt equity ratio has to be calculated in this manner. TO and TW ratio has to be calculated in this manner. So there is a lot of variation. Are we saying that in times to come, Institute of Chartered Accountant of India and the ministry will be having one more task of creating a accounting standard on these ratios as well?
नहीं, ऐसा नहीं है, Amit ji. 2 points. First, these ratios are well defined, and of course, the Institute of Chartered Accountants have already brought a guidance note on the CARO 2020. And again, repeating, these ratios are the requirement of CARO 2020. CARO 2020 clause 19. Whether the question is whether the auditors of the opinion that no material uncertainty exists as on the date of audit report that the company is capable of meeting its liability existing as on the balance sheet date as and when they fall due within a period of 1 year from the balance sheet date. And this is based upon the financial ratios which is they have to give a report. So these now financial ratios have been now. So at that time we asked NCA, so what are these financial ratios? Should we decide? They said wait. Now they have given that in Schedule 3. So these are the ratios based upon which the auditor will have to certify in CARO that whether the company that there is no material uncertainty exists, that the company is capable of meeting its liabilities existing as of the balance sheet date. यानी कि वो financially solvent है या नहीं है.
So if I understand correctly, it's a base provided to the auditor to ascertain whether a financial solvency is there or not, whether the company will remain solvent for the next 1 year or not. So up till now they were having no clue at all from where they will determine the solvency. Now they have some parameter, at least on the basis of these parameters they will be determining that yes, company is solvent or insolvent. Oh,
yes.
Wonderful.
Clause 19 of CARO 2020.
Great, sir. Great insight. Anshul, there is one, I think Raghuveer was also talking about this particular transaction reporting which has been added, that when company has any transaction with the companies which are struck off under the provisions of Section 248 or 560 of the 1956 Act. It shall disclose the name of the struck off company. That is one. Nature of transaction with the company. So either you may be an investor company or you may be investee company, or if there is any other type of transaction, what is the balance that is outstanding? What is the relationship with the struck off company? And the transactions can be, as I mentioned, can be in the nature of investment, receivable, payable, shareholding as an investor. So what is the logic of ministry adding this data in the balance sheet, and what the ministry is likely to do with this data? And also the third question I'm asking, is there any safeguard for the companies who are already into this? All these three questions, if you can give some insight.
Okay, so with regard to struck off companies, I think till this time, in fact, right now also we have a lot of confusions that what will happen if suppose in majority of the cases where the companies are struck off by the government, then what has happened to their financial statements, what has happened to their investments, what has happened to their asset liabilities? Nobody is having any clue. As far as when we are applying, of course there are some kind of financial statements are prepared and submitted, and application is made and all. Specifically this problem is more pertinent in case, say I am a company, say there is a company A Limited, and I have 5 or 7 investor companies in my as my shareholders, right? And they are the only shareholder in my company, and all of them were struck off by the ministry. Now, as a company, I am an operational company running my operations and all. But as a company, I'm stuck that who are my shareholder, because legally those companies are not in existence. So who are my shareholder? What will happen to my day-to-day operations with respect to the shareholders? Whether I need to make all these disclosures pertaining to shareholders or not? Who are my members in my register of member? So all those questions will come. And there is no legal answer to that those questions, and we are actually struggling to get the legal solutions for this. And government also at the same time doesn't have any kind of data available with them that whether such kind of what is to be done with such kind of companies. Unless we have the data, nobody can make do the analysis of this. So perhaps some more data collection exercise, and once this this adequate data is available with the government, then further more disclosures or further more clarity will come that how it will be taken further. Moreover, the forms which are presently filed for the purpose of this financial statements of the companies, those forms are still not aligned with the Schedule 3. Of course, it will come in the time to come. So there all this information in XBRL mode will go to the government. So there will a lot of correlation can be made with this kind of data. So I think it's a more data collection exercise for even for the government to know that in how many cases they are facing such kind of problem. And one provision which I am able to recall, I may be wrong, but I am able to recall somewhere in 2018 November, government came with some of the proposed changes in the Companies Act, where they have, of course, that provision is not yet come, but there was some proposal that in case of any struck off companies, all the properties belonging to those particular companies will be automatically transferred to the one of the authority formed by the government, and such kind of proposal was under discussion. So perhaps that is a step towards that how many such kind of companies are there, and how many what kind of property they are having, what kind of investment they are having. So it's a more data collection exercise, I believe.
Yeah, thank you, Anshul. I can understand and your limitations as well. You cannot say everything very openly. But I can ask certainly questions very openly. I want to raise an issue. There are companies who have invested huge money in other companies, and those companies have been struck off, and those companies have not been revived for reason known best to all of us, right? And there are other set of companies also where I am an investor and I have invested through these companies, and vice versa. My question to all the four panelists, anyone can answer. What is the solution for these companies? How you see that if I am as a professional being approached by a company that one of my investor has got struck off. Let's say there can be two situations. One situation which I am having presently also in hand, where there are three companies who were my shareholder, and all three shareholders have got struck off. Then who is my shareholder today? All three shareholders have got struck off. They have invested huge money at a premium. Now what to do? And there are other wise cases also. So anybody who can guide, because the government has started the collection of data today. Tomorrow action, as Anshulji was also mentioning, that something can happen of this nature. Or what else? What is the remedy if I have to find out? If anybody can throw some more light.
Here, one thing, Amitji, regarding this relationship with the struck of companies. You know, one of the basic things, very, very basic things of a financial statement, which is upon the management to ensure that these financial statements which are prepared are true and fair. Now, if a company is having a relationship with a struck of companies, which is a non-existent company, then how there can still be a debtor or a creditor or investment? It should have been written off. The value should have been nil. And you're telling to the stakeholders, I've got debtors of 10 crores, the debtors are not existing. That should have been written off. So
that is one set of problem. How you will write off the investment? If let's say the example that I have given,
it will be zero. Value would be zero. Actually, it's if I talk about investment, there is an AS.
No, my investor, my shareholder who has invested 10 crore in me has got
I'll tell you. That actually when this came, we had special sessions on this strike of companies, and that time also I told everyone. The law is, to my knowledge, in case there are certain assets who doesn't belong to anyone, and there is no legal heir, in that case, they belong to the government. So in this case, these shares belongs to the government. So you'll have to inform. When you inform the government that these shareholders are not there, strike off, the government would become the shareholder. You know, at that time also I told at various seminars, the general clause is that I don't know exact law, but there is a provision which says that
I very well remember at Mr. Anshul was also highlighting, but that didn't become law.
No, that is separate.
Proposal.
No, that is separate. That is already an existing thing. That if there is some asset found,
okay,
for which there is no owner, that belongs to the state. That is an age-old law. There is no new law required. No new law required. It is an age-old law.
Okay, all right. So we will examine into this aspect, yes. And I think we can get some more insight from this particular aspect. Raghuveer, there is a lot of talk on the conduit lending, and government has done a lot of restriction in respect of conduit lending and borrowing. I think the reason we understand is very clear, that government wanted to curb the black money flowing and the malpractices which were going under the PMLA or the FEMA. One problem, what I was discussing with Anshulji also in this regard just before this session, government has mandated a disclosure with regard to the conduit lending or borrowing. If let's say I am doing it in the permitted limit, 186 says that you cannot have more than 2 layers of investee in investment companies. And when I am doing within the 2 layers also, my balance sheet would be disclosing that it is a conduit lending. So in that case, how the government will be able to make a distinction? They will be thinking that I'm doing something wrong. Is that correct, or I'm missing something? Or maybe anyone else can make a comment. Tirupal or
No, you are talking about the 2 layers of companies, no?
sir, not 2 layers. There is one more provision. They have stopped the conduit funding. Basically, they want a disclosure on
that again, yes. That the money which is borrowed should not be further lended.
Correct.
Both received and granted,
Correct.
taken
Correct.
and recorded both.
Correct.
That again, if I talk about, is again the requirement of the auditor to say that the borrowed funds, whether it is and for the borrowed fund and the share premium, the auditor has to reply whether the company has advanced the loan for the purpose for which has been taken or not. So that is the requirement of CARO again, 9E and 9F. So again,
and it has not been routed through. It has my entity is not routed. Used for the routing this lending. Now that is what the disclosure is.
If it has been done for that purpose specifically, yes, then I have to state.
So that is
if it is not, you're right.
That is my worry. That is my worry, because law allows me 2 layers of conduiting, but here I am supposed to make the disclosure, and regulator will not understand whether I am in permitted limit or out of permitted limit. So I think that care has to be taken by the government in taking care so that it does not go other way. Anshul, maybe you can answer. There was a present requirement regarding the rounding off. Now, presently, the rounding off was to be adopted on the voluntary basis, if I can understand, for the preparation of the financial statement as per the Companies Accounting Standard Rule 2006. And nearest unit can be based on the turnover. Now, depending on the total income of the company, the financial statements are required to be mandatorily rounded off to the nearest unit. So are we saying that now rounding off is mandatory? There is no option available. As per Schedule 3, you have to round off.
According to me, yes, it is mandatory now.
So to bring uniformity all across in reading the financial statement of
yes,
peer companies, I think they have brought in that amendment.
And also this rounding off give more readability of the financial statement from the reader perspective. So it is now made mandatory. Till this time it was voluntary. That has become now a shell. So you have to do it.
Tirupal,
if I talk about here rounding off, comparability is not an issue, because the option is given less than 100 crores to round it off to 100,000 lakhs, millions or crores. One may round it off to crores, one may round it to 100, one may round it off to thousands. But this so that is not there. But yes, in India, yes, it is already mandatory. They have to mandatorily round it off. So here the option, what you rightly said, that now it has been taken away.
Yeah, all right. Tirupal, I think there is one significant change with regard to the registration of charges, and government on one hand cut your hand that you can't register the charges beyond 120 days. And now they are saying, okay, all right, I have cut your hand and now you are not able to register. Now tell me which charges you have not registered. So what is the government aiming at? I believe I can understand from where the government is coming, because I know at least 10 cases where I am not able to, my companies are not able to register because they have crossed 120 days, right? They don't have any option. Now government wants a reporting in respect thereof. What could be the consequence next?
So the one consequence will be disclosing the charges which were unable to be registered within 120 days through the financial statements as an information to the government. Maybe government can use and using the especially for the prosecution purpose or the condonation, whatever it is needed. Because if you look at the IBC provision which got incorporated in the charge chapter, like voidable charge against the liquidator, all those things. Once you have already made disclosure on your own, and those balance sheets are public document, tomorrow probably the lender will lose the right, and lender cannot do anything backdated or current dated or the corresponds so and so. So the whole idea of asking the information of charges which were not able to be registered within 120 days is to gather the information about the one is you have committed wrong or not able to, other one they want to know the facts, the third one they would like to say these people are not eligible for if company goes for the liquidation. Maybe to achieve 2-3 purposes they are collecting the data.
All right, Pramod sir, have you got any solution in respect of this problem? ये 120 days का मिनिस्ट्री ने कंप्लीट ब्लैंकेट बैन कर दिया, अभी कोई चार्ज रजिस्टर नहीं हो पाता है, आपके दिमाग में कोई सॉल्यूशन है क्या? मींस हाउ टू डील विद दैट?
I'm not, I'm just asking, beyond 120 days, you cannot register, but can you still apply for the condonation and pay the penalty and then fine?
No option, sir. No option.
So the only way out there would be that you inform there and then they would be imposing the penalty, go for compounding.
No.
So they want the information from the company itself.
Sir,
And take care, Amitji, take care of especially the loans taken for vehicles from the NBFCs.
The difficulty is that for compounding, one of the condition is that you have to make the offense good. So you
that RD will tell, or the straight away penalty would be levied, no compounding. That's all.
All right. I thought I'll see, maybe you have got some different solution for that. You always have something. One very interesting point which I wanted to discuss. We are coming close to the session and also there is a lot of confusion with regard to the cryptocurrency. Now that is a new currency that India has got or the world has got, and there is no clarity. Once I saw this notification, then again I was little confused. Are we saying that we are on a path of legalizing the cryptocurrency? Because as I understand, the first notification that came in 2013 of RBI was saying no, we can't allow cryptocurrency in India. In 2018, they said that if you are regulated by RBI, then you cannot have any cryptocurrency in your balance sheet. Now you are completely disallowed to deal in the cryptocurrency, but that was a stand of RBI. Government of India perhaps has got a different stand, as I am able to read and understand. But now since my balance sheet has also been mandated that additional disclosure with regard to the cryptocurrency transactions, right? If you have made any trading or if you have done any investment in the cryptocurrency and if you have got any profit or gain or something, then you are required to make the disclosure. Now, point is that if it is not legal, will anybody like to disclose? Or is it that it is my understanding is incorrect and government has not banned the companies from doing the investment? This is one part. One more article I was reading, I think what the government has also attempted and came to notice that there are a lot of companies who are running the collective investment scheme, wherein they are pooling the money in one company by way of collecting the fund and investing in a cryptocurrency, and they are giving a return. So is that intention that government wants to bring those companies also into the regulation or something like that? Or please explain what exactly is the scope of this particular disclosure? Maybe Raghuveer, you can take, I think sir has...
Sir, I don't know much about this cryptocurrency, sir.
Acha, sir is back. Yeah. So,
you know, there is a huge, I would say, no controversy, but there is no settled proposition that cryptocurrency is banned in India, that it is illegal. It may be legal or not, but it is not illegal. It is not banned. Now, because I had a year back where one of the entities registered the company basically to trade into cryptocurrency.
yes.
So that was allowed to be registered. And now if you see the current IPL, you are seeing the ads to invest into cryptocurrency through a mobile app. You know, you've
Yes.
seen that.
Yes.
So whether it is banned or not, illegal or not, I don't know. The only thing is where a company has traded or invested. Now, suppose I have made a sales, I've rendered a services outside India, and there they have given me the money in a cryptocurrency, and I have encashed that. So when I have rendered a service for against which I have received a cryptocurrency, so that is quite fine. But now when I sell it, then I have traded into that. So that needs to be reported out here. So I have to just give the details that yes, I have traded into this cryptocurrency. That's all. I don't think so. I don't think so. There is any specific ban somewhere.
All right. That is what I'm also interpreting, because yes, for RBI, I can see, because 2018 circular, I can see where the RBI has very categorically banned that the entities which are regulated by RBI, that is NBFC, bank, and the other financial institution, they are completely banned into deal with the cryptocurrency. Their balance sheet cannot have any such item. That is one. That is for sure.
Maybe they have not allowed them because this virtual currency anyone can create.
Correct.
Anyone can create. So at that moment, what I remember, it was that RBI would start off its own. something like that, a cryptocurrency.
Maybe possible.
So they have not allowed that. So if someone is doing in Bitcoin something.
Again, if I take that discussion a bit more forward, because as a accounting person, if let's say I have purchased the cryptocurrency, definitely it will not be cash or cash equivalent. It would be shown under the head investment if I am not incorrect. Presently, if
it would depend. It would depend. It would depend because it can be in cash. It is as good as investment. Yes, Bitcoins, then it's invested value, then its current value. If I show, because it will not come like as it is because I have invested directly. Merely investment, I foresee out here that individuals are doing it, companies are trading it, and normally the transactions are settled in Bitcoin. But yes, I fully agree with you that it cannot be ruled out that a company is investing into a cryptocurrency. So yes, in that case, again, it would be as per my AS11, where investment and then its fair market value as on the year end would have to be disclosed in the Schedule 3 also.
All right.
It still remains as on 31st March.
Yeah. Sir, there are certain changes with regard to although I know that's a very detailed subject, I would not indulge into, but maybe the accounting related aspect which had been now brought in the Schedule 3 as well with regard to the corporate social responsibility, because that is a subject which is going to impact in the current year also for the companies. So can you briefly explain what should be the accounting treatment in respect of unspent amount? how the provisioning should be made, if I want to treat, if I want to carry forward, whether the asset creation should be done in respect of the excess money or not. Likewise, if you can just...
Amitji, for March 21, we all know that, yes, for March 21, 22nd January, this provisions of Section 135, 5 and 6 amendment made applicable. The rules were made applicable. So now, up to March 20, there was no requirement. It was either comply or explain. Now it is, if you don't comply, you have to give it to the government. Schedule 7 fund, ongoing project or otherwise. So for 31st March 21, I will have to create a provision. I'll have to create a provision for the unspent amount, so that if it's an ongoing project, I transfer it within 30 days to the unspent CSR amount to be spent within the next 3 years. And in case it is a one-off project, then I have to transfer it within 6 months. And then not spending it, penalties are there, auditors have to report. But the second thing which you said, excess spending. The excess spending would depend upon the CSR committee, its CSR policy. If they want it to be adjusted towards the future CSR spending, then only they will create an assets of prepaid. Otherwise, they will write it off as an expenditure that year. So depending upon what is the call of the board, as per the CSR committee and the policy, that the excess spent amount would be carried forward to be set off in the future years or not. So it would depend upon the policy of the CSR committee approved by the board.
So given the choice, me and you will agree that whosoever is given the benefit that you...
No. Aisa nahi hai, Amitji. There are various PSUs, there are various companies who are already spending more than 2%.
Achha, okay.
Case to case. Both correct.
So given the choice, I'm saying ki, if the company decides that I want to take the advantage of a carry forward, so they have to take a creation of the asset in their financial statement in the 31st March 2021. Then only they will be allowed to make a set off in the subsequent year. Is that correct?
Right.
All right. I think there are, although we have just touched the time limit, but there are a couple of questions on the revaluation. As I understand, I think there is not much change on the revaluation. Only thing is that Ind AS was, although talking a lot about the fair valuation of your assets and other thing.
No, sir, Amitji, a huge change.
Yeah.
I'll tell you what. Because we have been trying this. We have been trying this with the MCA through the Valuation Standards Board of ICI. We have been trying that wherever a revaluation is required, that revaluation should be done by the registered valuer.
Yes.
Even in the case of AS or the Indians, because these revaluations were being done by other than the registered valuers.
Correct.
So now they have said that if it is done by other than the revaluations, registered valuers, reporting is required, not only here in the car also. That takes care of the revaluation being done by other than the registered valuers.
Yeah, I think that's a one point. And I think there is one more change with regard to the capital work in process or the assets which are, I believe that is due to COVID disruption. I think government want to...
No, not COVID. Sir, you see several balance sheets carrying on capital WIP for under umpteen number of years, 8 साल, 10 साल, पता ही नहीं कितने साल से चल रहा है. तो aging दे दो. Whether the project has stopped or it is still continuing. Stopped का अलग दो, continuing का अलग दो. और stopped का है तो आप ये बताओ by what time you will complete it. They must have analyzed the financials and seen that capital WIP is a huge amount. Say 100,000 crores. तो भाई जो भी है finalize करो, capitalize करो, whatever you want to do. So their aging they have required.
Yeah, I think we are done with the basic issues. I'm sure there are some 40-50 questions are there on the chat box also, but I don't think we will be able to take them. But yes, we can request Chaitanya, if you can allow maybe 1 or 2 participants, if they have any very pertinent issue which has still remained unanswered, and we want to take the benefit of expert available, we can definitely ask them to raise their point.
Yes, sir. I can see that CSIP Manish Baldevji has been raising his hand for so long.
Please
So
allow
if
him.
he, yes, sir, if he wants, he can unmute himself and proceed with the question.
Thank you giving me opportunity to raise the question. My question is related to strike of companies when those strike of companies are promoters or the shareholder of the company. As Anshulji was mentioning, if all the promoter shareholder companies are struck off, then how the AGM will be conducted or the accounts can be adopted? By default, there cannot be constitution of quorum at all at the AGMs.
I think Pramodji has already answered this question by way of saying that if there is no owner, the asset goes to the government of India. So there is no requirement that you will be required. But I can understand, Manishji, from where you are coming. I was also asking the same question to Pramodji. I think
दो तो shareholder individual होंगे.
नहीं है सर,
AGM तो हो जाएगी.
all are body corporate.
100%.
100%.
तो आपकी कंपनी भी गई और क्या?
There can be two companies shareholders.
And if both are struck off, then invite the government.
But that would be a long-driven process to invite government nominees to come for AGMs. Will have their own problems or challenges.
You can request those struck off companies to restore and then transfer the holding. And I think there's some legal way can be found out after that. Or maybe I can give one more solution. You can explore the possibility of filing a winding up under section 271. 248 last subsection gives the option to the company to wind up in respect of companies which are struck off even. So if you go for winding up, the assets would be distributed. And if there are individuals who are the shareholder of those struck off companies, those shareholder will become the shareholder of this company, of your company. So without restoration, you will be able to have the shareholders in place. That is one I have not worked out, but yes, that seems to be one legal possibility. We can discuss that.
Yes, we can explore this way.
Yeah.
Yes.
Thank you. Yeah, all right. Is there anyone else? Maybe we can allow one more last and we can close. I think it's a long session.
No, sir. There are no other hands being raised. But if any participant has any pertinent question, they can unmute themselves, please. I request only one participant, please. I think, sir, all the queries have been answered.
Yeah,
and none of the participants. Yes, sir.
Yeah, Sudhakar sir is there. I think we can request him. He may have something. I think Sudhakar sir, you are there.
Yes, sir. He's in the session only.
Yeah, he's there. But
Amit, I don't have any questions as such. I'm in fact, Pramod and Anshul as well as Tirupal, they have very well answered all the issues, and especially Pramod, the accounting related aspects, he has very well covered it. In fact, to a large extent, I agree with him also. Thank you.
Thanks, Sudhakar bhai.
Thank you, boss. Thank you.
Chaitanya, I think we are done with today's session. We have benefited a lot. My compliments and thanks to all the panelists. Extremely grateful to be part of this session and grateful to moderate this panel discussion on the Schedule 3. I have learned a lot. I don't know about the others, but indeed it has been very, very insightful deliberation what all the panelists have done. And I'm sure all the participants must have also benefited. Thank you, Pramod sir, for I know you have been having a very, very tough day, busy schedule. Despite that, you have find out the time. And thank you, Raghuveer, for setting the tone for the discussion for today. You have covered all the aspects very well from where this discussion had started. And Anshul, you have always been very crisp and sharp on the subject. Your knowledge has been beyond par, and I'm always grateful to your deliberations, what you are making, and the points. And Tirupal, amazing, means you have always been bringing a new innovative points for which compel all of us to think about from the different dimension, that yes, this can also be the dimension. So thanks to each one, and thanks to all the participant and the corporate law advisor for giving me this opportunity. Over to Chaitanya.
Thank you, sir. Thank you, experts, and thank for taking
Chaitanya,
time.
one
Yes, sir.
minute.
Yes,
Just
sir.
before you conclude, that I must appreciate the way Amit squeezed. He won't even grill the panelists. He squeezed the panelists to the core, and then he will say, "Bhai, now aap jaake ghar mein aaram kar lo." Thank you very much, Amit. In fact, the depth of your what's called as hunger, as far as the knowledge is concerned, is immense. Is commendable. In fact, there is no other alternate words for that. I must propose a very hearty vote of thanks to you.
Sir, my pleasure. It's
Very
always all your
right.
motivation. Thank you, sir.
Thank you, sir. Thank you, Sudhakar, sir. Thank you, experts, for discussing such an important and intricate topic, which has been concern for all the professionals. And we hope that our experts have cleared your doubts regarding the upcoming change in the Schedule 3. So, participants, this brings us to the end of today's session. See you all in the next session with new topic. Till then, goodbye, stay home and stay safe. Thank you so much.
Chaitanya, just one last announcement.
Yes, sir. Yes,
there
sir.
are a lot of questions, and I have saved all those questions in my Word file. So we will be replying whatever is not covered today, because I think time was not there to reply all. But we will see if there is anything left out that we can reply separately also. Yeah, that was just a message.
Okay,
You
sir.
can
Thank you
close,
so
Chaitanya.
much.
Yeah.
Thank you,
Thanks
sir.
to all. Thank you to all. Thank you.
Thank you.
Thank you.